Okay, good morning and welcome to our latest webinar from Benson Wood Chartered Accountants, and this is our guide to company cars. So I'm John Moffat. I'm Director and CEO at Benson Wood & Co, Chartered Accountants and Business Advisors in Airdrie. We help a range of owner-managed small businesses, and one of the things we get asked a lot of questions, I've been getting asked a lot of questions on recently, are company cars and the tax advantages and disadvantages, particularly regarding electric cars. So today we'll cover that. So that's just a picture of me in my younger years. So company car tax. So first of all, if you're thinking about how to run cars and vans through your business, there are many personal tax issues to consider, and this presentation will help you decide on the best option for you. So company car tax. If you're driving a car provided by your employer and it's available for you to use personally, it is viewed as a taxable benefit. HMRC attaches a monetary value to the private use of the vehicle and collects tax on it. This is what we know officially as benefit in kind tax, or BIK or BIC, so we'll refer to it as BIC from now on. There are two separate BIC tables, one for those driving a car registered after 6 April 20 and one for those that drive a vehicle registered before that date. So calculation of the tax is based on the CO2 emissions of the specific car provided, combined with a few other factors, and these are, as mentioned, the list price or P11D value of the car before non-taxable items, for example road tax, and after optional extras. So if you buy any extras with your company car, you need to add these on, and that increases the list price figure and P11D value. It also depends on the tax rate you are in. So in England, that could be 20, 40 or 45% based on what your annual income is. And in Scotland, it could be anything from 19, 20, 21, 41 and 46%. 21, 41 and 46 are the main values in Scotland. And it also depends on the type of fuel the car runs on. So the easiest way to work out the tax you pay is by using HMRC's own tax calculator. You can just Google that, and that will ask for all of the above details, plus any tax reducing facts like your contribution to the initial cost of the vehicle and the percentage of use. So a calculation example in 3 steps would be to determine the car's list price, or P11D value, multiply this value by the company car tax rate based on its CO2 emissions. This is the BIC value, and multiply the BIC value by your personal tax rate of either 20, 40, 45% to get the amount payable. And remember, in Scotland, it's 21, 41 and 46%. Okay, in terms of fuel type, petrol and diesel vehicles, the tax bill in diesel vehicles will typically be more expensive. There is a 4% surcharge on diesel vehicles. And because of the lower CO2 emission, hybrid cars can be a great alternative. These vehicles will fall into a lower car tax band. So moving on to personal tax on a company van. If a vehicle is classed as a van, i.e. a commercial vehicle, the benefit is taxed slightly different compared to a car. Instead of looking at the list price and CO2 emissions, there is a flat rate figure that HMRC provides. This changes every year. There is also an option for a zero emission van. There is an even smaller taxable benefit in kind compared to a standard company van. In terms of fuel now, if your employer provides fuel for your company vehicle, this will give rise to a separate taxable benefit in kind. If fuel is provided for a company car, you take an apportionment of the flat rate fuel figure depending on your vehicle CO2 emissions. So it's the same percentage that's applied to your car list price as applied to the flat rate fuel figure. If fuel is provided for a company van, however, a standard flat rate figure is used as for the van benefit itself. In terms of mileage rates, we'll talk about them for a bit. If you use a vehicle for a genuine business trip, either using either a company car or a private car, your employer can reimburse you by using HMRC flat rates. According to HMRC, trips are seen as business related when the work can't be done unless the trip is made, and the employee needs to be somewhere other than the usual workplace to carry out the job. So doing from work every single day to the same place of work wouldn't count. There are different rates depending on whether you use a company vehicle or a private vehicle. It's worth noting that your employer reimburses you these amounts. You can make, if the employer reimburses you below these amounts, you can make a claim for additional tax relief in the difference. Conversely, if the employer reimburses you above these amounts, the difference will be subject to income tax in full. Moving on to government grants. A further encouragement to buying a low emission vehicle is by way of a government grant. You can get a discount in the price of a brand new low emission vehicle through a grant that the government gives to the vehicle dealership. So the amount of grant is primarily dependent on the type of vehicle purchased, but includes cars, motorcycles, mopeds, vans, taxis, and large vans or trucks. Remember that the grant will not reduce the taxable benefit in kind. The taxable benefit in kind is based on the original list price. And if you Google government plug-in car and van grants, you will just see the conditions that the government are set up for this. So in terms of leasing or buying a company vehicle, for an employer, whether a vehicle is leased or purchased may have substantial differences to the amount of tax relief obtained. In either situation, the benefit in kind position for the employees is not affected. So first of all, looking at purchase of a vehicle, if you purchase a vehicle, you'll be able to claim capital allowances on it. There is a set percentage that can be offset against your profit, and this is dependent on the vehicle's CO2 emissions. If you buy a vehicle via a hire purchase agreement or HP agreement, under a hire purchase agreement, legal ownership of the vehicle passes to the company at the date the contract is signed. You will then simply pay for the asset over a period of time, normally on a monthly basis. Monthly HP repayments will contain both an interest and capital repayment element. The capital element is not an allowable deduction against business profits, whereas the interest element is. You will, however, be able to claim capital allowances in the capital element of the repayments, similar to if you purchased the vehicle, as previously mentioned. In terms of leasing a vehicle, there are basically two types of lease: an operating lease and a finance lease. An operating lease is where the business simply pays a rental based to the legal owner of the asset. All expenses incurred can be offset against business profits. Another name for an operating lease that you'll know is a contract hire agreement. A finance lease is where the business is required to treat the lease in the same way as if it had bought the vehicle by way of a loan. The business will therefore depreciate the asset over its normal life and will charge depreciation and interest payments against its business profits. This is one of the only times a business will get a tax deduction for depreciation. In either situation, the asset is being borrowed from somebody else, so no capital allowances can be claimed. So that's in the contract hire and the finance lease options. Where the vehicle in question is CO2 emissions of 110 grams per kilometre or more, only 85% of the lease cost will be allowable. And if your business is VAT registered, you can claim 50% of the VAT relating to the lease of company vehicles, even if there's private use of the vehicle. You can claim 50% of the VAT. Moving on to electric vehicles. Okay, so with the sale of new petrol and diesel cars set to end in 2030, and also increasing fuel costs and the ongoing threat of climate change, it's little wonder that more people than ever are considering changing to an electric car. But before you take the leap, it's important to make sure you're clear about the tax implications of an electric car purchase, hire purchase, PCP arrangement, or lease. So these are a number of the questions we get asked regularly on electric cars. So I'm going to run through them one by one. So the first question is, can I claim capital allowances in the purchase of an electric car? And short answer to that is yes. The arrangements are different from those you can claim for petrol and diesel vehicles, and the amount you can claim will be reduced by any personal use. That's for a sole trader or partnership business. Unlike other cars, electric cars qualify for first-year allowances. That means you can deduct the cost of the vehicle or of the car from your profits before tax in the accounting period during which you purchase the vehicle. If you use a car for personal journeys, you will only be able to claim in proportion to the time you use your car for business journeys. That means if you use the car for personal journeys 10% of the time, you will only be able to claim 90% of the cost of the car in capital allowances. And again, that's just the case for sole traders and partnerships, not limited companies, which can claim the whole lot. Because you're likely to be able to reduce your pre-tax profit significantly, you may want to consider in which tax year you make the purchase of the vehicle. The benefits may be greater in a year with higher income. So for example, if you've got a really good year, you're into higher rate tax or super rate tax, it can be advantageous to put the vehicle through in that year. Doesn't have much of an impact on companies, but in terms of personal sole trader businesses, that can have a big impact. You can claim capital allowances when buying outright or with a hire purchase agreement. This is a big one, should you subsequently sell the car, however, there will be a tax charge on the amount received. For example, if you buy an electric car for 40,000, you get 40,000 against your profits in the year you buy it. If you sell it 3 years later for 25,000, a figure of 25,000 would get added onto your profits. You would pay tax on it. So you get a good benefit at the outset, but you'll get a tax hit at the end of it if you sell the car. Next question we get asked a lot, can I reclaim VAT on the purchase of an electric car? So the answer to that is, as a general rule, no. However, if you're VAT registered and the vehicle is used exclusively for business, you can. Therefore, that's only likely to apply in the case of pool cars available to all employees and kept at the premises or the business premises or taxis. What about a personal contract purchase arrangement? So PCP finance deals are a very popular way of purchasing vehicles nowadays, often consisting of a modest initial deposit, followed by a series of comparatively low monthly payments. At the end of the term, however, you will generally have the option either to trade the vehicle in for a new one on a new contract or make a balloon payment to own the vehicle outright. However, crucially, PCP arrangements will usually be considered to be a finance lease, so they would not normally qualify for first-year capital allowances. As a result, there could be significant tax advantages to opting for a hire purchase agreement rather than a PCP arrangement when buying an electric car for your business. That said, there are some circumstances where the detail of a PCP agreement means it would be eligible for first-year capital allowances. This could be the case where the balloon payment element is below the expected future value of the vehicle. You should seek tax advice if you're considering this option with a view to claiming capital allowances. So from your accountant, us, whoever, ask, get the agreement, a copy of the agreement to them before it's signed so we can look at it in detail. Next question, what if I lease an electric car? So if you lease an electric car, you could deduct that leasing cost from your taxable profits, again in proportion to your business use. Again, that sole trader businesses, partnership businesses, the business use is relevant. For limited companies, you would take the full lease cost against your profits. With this route, leasing allows you to spread the cost, but you lose the significant tax benefit that comes with first-year capital allowances when purchasing an electric car outright. Nevertheless, there are benefits to leasing rather than purchasing an electric car. This is a big one. Current battery technology means that performance does degrade over a few years, and so batteries, which are a significant element of the overall cost of the vehicle, will need replacing reasonably quickly. By leasing, you avoid this issue. So that is, as I say, that is a very big point, that if you lease a vehicle, you are reducing your risk of, say, a very high depreciation of the vehicle when it's approaching the end of its battery life. So that's a major thing when considering whether to buy or lease an electric car. Next question we get asked quite a lot is, can I reclaim VAT on the lease of an electric car? There is a 50% block on input VAT recovery if the car is available for private use, whether electric or not. If not available for private use and purely for business, 100% of the VAT being reclaimed. For VAT purposes, the rules are no different whether the car is electric or not. So 100% of the VAT if it's a pool car available to all employees in the business and is kept at the business premises. Next question, what mileage claims can I make for electric car journeys? If you're leasing an electric car through your business, you cannot claim the mileage rate at all. This is different if it's a car that's provided by your employer, where you can claim 5 pence per mile. However, if you pay for the lease or own the electric car personally, then you would still be able to claim the relevant mileage rate of 45 pence or 25 pence from your employer, irrespective of the fact whether it's electric or not. If you charge at home, you can claim 5p a mile, even if the business pays for the lease. A thing we get asked quite a bit about as well is charging points. So you can claim back the VAT element of a charging point if you're registered for VAT. You can also deduct the cost of a charging point in proportion to your business use. And if you have business premises, the government offers a scheme to help with the cost of the installation of electric car chargers at those premises. Again, if you Google that, it's under guidance, working charging scheme guidance for applicants at the government UK site. The government is also offering grants to people with off-street parking to assist with up to 75% of the installation cost of electric car charging points at home, capped at £350. And however, for people who own houses outright or with a mortgage, the scheme ended in April 22. Some other benefits of electric vehicles: there's congestion charge exemptions. So electric vehicles are exempt from congestion charging and clean air zone charging. Government grants, we mentioned the government plug-in grant provides 35% of the purchase price, up to £2,500 towards the cost of eligible plug-in vehicles costing less than £35,000. Above that figure, they don't get any grant. Next question, do I have to pay vehicle tax or road tax? There are exemptions from vehicle tax, meaning it's free to tax electric vehicles. So road tax is free. The benefit in kind rate for vehicles was 1% last tax year, is 2% this year. Electric cars, in terms of other taxes we've mentioned before, exempt from congestion charge. And company cars which have to travel in and out of cities all the time will hugely benefit from this additional saving. Just some other benefits when using electric vehicles. In terms of electric charge points and charging costs, any business that installs charging points for electric vehicles between now and 31st March 23 can claim 100% first year allowance for these costs. In terms of electric vans, the taxable benefit for having the private use of a zero emission van was reduced to nil from April 2021. In the previous year, electric vans were taxed at 80% of the benefit of a normal van. So that's a big shift there. Government grants, again, we've mentioned this. So government plug-in grant provides 35% of the purchase price up to £2,500 towards the cost of an eligible plug-in vehicle, costing less than £35,000. The plug-in grant applies at the time of purchase and is typically given as a discount to the purchase price of the vehicle. And another benefit, salary sacrifice. So where an electric car is provided under salary sacrifice, the optional remuneration rules do not apply. So I'm going to go off script a wee bit and just talk about my experiences in terms of electric car and some other just points relating to, first of all, North Lanarkshire Council. They provide, for anybody watching in that area, they provide free charging in terms of the charge points. I don't know how long that will continue, but at the moment, all the public chargers are free to use. In terms of, if you're looking at moving to an electric vehicle, the miles quoted by the manufacturer, the miles you actually achieve in real life are usually quite a bit less. So, for example, the car that I use, the electric car I use, the manufacturer says I'll get 280 miles on a charge. I'll only get roughly about 220 miles, although it does increase. It's better in the summer. So during the summer, the batteries perform better. You generally get more miles. Another of my points was, again, a lease is less risky than buying outright, although you'll get less allowances up front if you lease rather than buy. If I was buying a car for long journeys, so if I was up and down the country, I would definitely consider a Tesla because of the Tesla charging network. There are banks of Tesla chargers and a lot of service stations, whereas other non-Tesla cars, you can struggle to get a charger in a service station. Charging network, it's improving as we go along. In Scotland, it's all the one, it's Charge Place Scotland, so you just need one card and to sign up for Charge Place Scotland, fairly straightforward. In England, there are multiple different companies that provide chargers, so you have to sign up with them all in some of the cases. Occasionally, you can just use your credit card for it. There's a lot of basic chargers, the same as home chargers in both Scotland and England. They are slower. It'll take your car a while to charge, and the 50 kilowatt per hour chargers are much faster, and they're also bringing out, I've seen quite a few now, 120 kilowatt hour chargers, per hour chargers, which will charge your car a lot more quickly. The price of charging stations has gone up recently as well, generally, because of the increased price of electricity. If you want to message me, we've got a free guide to company cars. We can issue that to you. And just, again, talking from personal experience, electric cars, plan your journeys. And on our trip to Cornwall last year, I ended up in a supermarket car park at midnight. And it wasn't the best experience in the world. So always plan your journeys. So that was just some extra personal tips on electric cars. So I think that's me covered everything. Thanks very much for listening. Have we got any questions, Joe?
No, can't see any questions, John.
No questions. So thanks very much for watching, folks, and we'll be back again probably later this month for our next webinar. Thank you very much.